Bill Ackman is arguably one of the best investors of our generation, has made billions of dollars being a hedge fund manager over the past few decades, and he made a $2.3 billion investment in Uber that he disclosed late last week. This is something that really moved the market, and this could be something that helps drive Uber forward, gain investor confidence in their vision for the future. That's not just about improving the business that we know today, it's also about investing in an autonomous future. So I want to go through a little bit of Bill Ackman's history, why it's at least worth keeping an eye on what he's doing, go through what he may be seeing in the core business, and then what Uber's vision, what their stated vision is for the future. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. First, let's go through a couple of Ackman's big winners over the last few years. One that's done extremely well for Ackman over the past nearly a decade is Chipotle. Took a huge position in the company when it was going through the E. coli crisis. That paid off extremely well with high gains with Chipotle just by simply buying and holding the stock mostly over that period of time. Another big investment that he made post-pandemic was Alphabet. Alphabet, arguably very undervalued in 2023, bought that, now is starting to exit that position. Ackman has a history of a combination of value investing and long-term buy and hold investing. That's why I think this is such an interesting position in Uber. So let's look at some of the metrics that are important for Uber, what Ackman may be seeing. You can see here from this revenue chart, this is all trailing 12-month numbers. Uber has a lot of momentum in basically every part of its business except for the freight business. Kind of just steady as it goes in the freight business, but in deliveries and in mobility, consistently growing that business. But if we flip this over and look at adjusted EBIT, that's a proxy for the cash flow that's going to be coming from each of these businesses. You can see that the growth has been absolutely phenomenal and steady since the middle of the pandemic. Now nearly $9 billion in adjusted EBITDA. That's for a company that's trading with an enterprise value of about $170 billion today. So phenomenal results. They've actually been able to grow their business and increase that take rate. That's the percentage of each ride that they're actually going to generate in revenue. You can see that in this chart here. Really, since the depths of the pandemic, Uber has been increasing that take rate on all of their businesses. That's allowed the profitability that we see. It's improved the company's economics, and Uber has reached scale. So there's potentially a solid moat around the business. They have the supply-demand dynamic that you need in a two-sided market like you have with ride sharing. So what Ackman is certainly seeing is a business that continues to do better and better financially, has really solidified its position in both ride sharing and delivery. That's going to be really difficult for anybody to upend unless we get some sort of changes with autonomy. But that's where the company's recent presentation during the company's earnings report for the fourth quarter of 2024 is so interesting.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
If you look at Uber's financial reports, and this is where they put their press release supplemental information, but what they put in the fourth quarter release is actually this autonomous vehicle spotlight. This is included in some of their supplemental information. So if you go to this one, you're going to have a lot of this same information. But the fact that they broke this out to actually a separate spotlight for autonomous vehicles and talked about exactly what they see going on here, I think is really important because Uber sees the potential disruption from autonomous driving, and they're trying to get out in front of that. And so we can see the strategy that is currently playing out. I think the way to look at this is Uber wants to make the market much, much bigger. That's what it's done with all of these moves. So you started Uber with black cars, then you have Uber XL, Uber Comfort, Uber X, Share, Shuttle, personal cars, and now you get to a $1 trillion opportunity ultimately with autonomy, and the goal is to get this to under $1 per mile. Just think about how that would change the way that you would potentially use Uber. Right now, you're paying between $2 and $3 per mile. If that's under $1 per mile, I think it really changes the use cases. Is it something you maybe use every day, especially if there's an autonomous vehicle anytime you need it? This really lays out what the strategy is going to be for Uber and for potentially a lot of these companies here. What Uber wants to do is make autonomy a commodity. They want lots and lots of suppliers in the market. They want lots of technology suppliers, they want lots of manufacturers, and they want lots of fleet owners. So the first partnership they have is with Waymo. That's not a company they're going to have a lot of power over, owned by Alphabet. Waymo's trying to do a couple of things. They're trying to test out both building their own ride-sharing network. So they have their own Uber or their own Waymo app in a lot of cities. And then they have tried at least partnering with Uber in cities like Atlanta, where Uber is going to actually operate the fleet. So they're going to do the ride-sharing business, have the app, and actually operate the fleet. But that's a pretty small test. What Uber is trying to do is get a whole bunch of other companies involved in autonomy as well. WeRide is the company that they're using in the UAE. But they've listed a whole bunch of potential partners here. These are all companies that they're basically putting up a sign and saying, hey, we are open for business when it comes to autonomy. So Zoox is owned by Amazon. You obviously have Tesla. May Mobility has a number of partnerships in the industry. Aurora is publicly traded. Nuro is a smaller vehicle. Pizza delivery is something that they're known for. Motional, NVIDIA, more of a technology provider, but they're going to be working with companies like Toyota. And then Mobileye is the one that now has a partnership with Lyft. So potential competitor there, but they're working with Volkswagen on vehicles, and they're a supplier to almost every single automaker in the world. So that could be a potential horizontal service provider working with OEMs who would then tie into Uber or Lyft or any of these ride sharing platforms. So that's what they want to see. They want to see lots of supply, lots of technology companies, lots of manufacturers in autonomy. That's what's going to be good for Uber's business, because that's going to commoditize supply for them. Then they're able to attract more and more demand, grow the business 10x, maybe even more than that from there. So I think that's ultimately the vision. They even said, hey, we will help you commercialize. We will help you get through regulations, scale up your ground operations. So cleaning vehicles, charging vehicles, doing all that stuff. We have a high utilization network. We'll help with variable demand, filling in those gaps. They give that with this chart here. Sure, you're going to be busy during the day. What are these vehicles going to be doing at night? We're going to help fill that demand. We're going to help build a business model there. And they have the safety record. Uber also has more data on cities, not only in the US, but around the world than any other company. This is just a look at some of the variability that you have, even from a seasonal perspective. Some places are going to be really busy in the spring, no real business in the summer or early fall. Then it spikes up around the holiday time. So where are you going to want to have vehicles? Where are you going to want to have a fleet? Uber's going to be able to help with those things. That's what they're saying. This is a we are open for business sign, and we want to get our costs from a little over $2 per mile today to under $1 per mile. Here's all the things that we can help with: hardware platform, vehicle financing, autonomous vehicle operating, fleet management, demand generation. All of these things are Uber saying, hey, we want autonomy to be the future, and we want to help you commoditize yourself if you are a technology provider, a hardware company, or a fleet operator. So these are all things not necessarily in the numbers today for Uber, but that's something that Ackman is potentially buying for the future. Remember, he's not just buying the growth that we have seen already, he's buying the future growth in Uber. So you add all this together, I think Uber's in a very, very good position. Interesting to see Ackman put $2.3 billion to work to buy a stake in the company. Not a huge stake in Uber, given Uber's size. And I've actually added Lyft to my portfolio because it's a little bit smaller, potentially more upside from autonomy. They could potentially disrupt their own business a little bit easier than Uber could. I look at that as kind of a basket in autonomy, because I think ride sharing, if autonomous technology is commoditized, ride sharing is going to be a great point to add value. But let me know what you think about Ackman buying a position in Uber. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.